We are running headlong into another global financial crisis in the exact same way we saw 2008 really derail the US and also the world economy.
Apple's under pressure, Yahoo down 8.5%, Cisco 6.5%, Research in Motion 10%.
And we're not getting the bid wanted, we're not getting the stop trading, and we see where the buyers are. We're just, every day they're pounding it. Can't look at it after you buy it, because it's so horrible.
We're seeing those exact same ingredients, but worse in 2025. This is not hypothetical. We have already seen two medium-sized businesses, Tricolor and First Brands, both in the auto industry, already go bankrupt to much of a surprise to Wall Street. And we've got some clear evidence in this video that nobody saw these liquidations or Chapter 11s coming until maybe a day before it happened. In 2008, products called CDOs, or collateral debt obligations, that allowed them to slice up everyone's mortgages, put them all together in order to increase returns while supposedly decreasing risk. Now, that might have been true to individual investors. If you get a piece of 1,000 people's mortgages, yeah, you're likely not to lose all of your money buying one financial product. However, as the years have gone on, the risk has been shifted from big banks and about mortgages. Now in 2025, we're talking about private lenders and corporate debt as the main source of systematic risk.
Short-term incentives with very little moral reticence. Of course you have a problem. It's hard to fix human systems without fixing human incentives.
After 2008, we had the Dodd-Frank reforms passed by the US government, which are just regulations saying systematically large, important banks are no longer able to trade as risky financial products. That placed big banks such as JP Morgan or Wells Fargo under the thumb of the US regulator. However, that did leave individual little businesses with lots of money and investors to fill that gap. I've got a few dot points here summarizing the size of this issue. So first up, we have leverage loans. They are known as just extremely risky loans, or you have a higher risk of bankruptcy. That has grown to $400 billion as of Q3 this year. That's a record. We also have private credit in general. That has grown from $100 billion in loan size in 2007. That is now 1.7 trillion. All of that sounds like, yeah, maybe investors and private institutions or just people with a lot of money, those are the ones taking on all the risk. But that's not exactly true either. They are the ones that are initiating loans, but because they're sold up and packaged up as financial products, they're finding their way onto still big banks' balance sheets. Barclays, which is a huge bank in the United Kingdom, they are exposed to £20 billion worth of these private credit loans. And that is a huge exposure considering Barclays as a company was only worth about $20 billion at the start of 2024. Now that we have the idea of this systematic risk is still present in the world economy, we can go into the two recent case studies just to see how clueless Wall Street is to these risks that they've created and how quickly things can come tumbling down.
Credit spreads are still almost record lows. So people are still partying. You know, if the punch bowl's being taken away, only a couple people may have noticed it yet. But so far, it's still partying like it's 1999 in the credit markets for the most part.
Let's begin with First Brands, which is an auto parts company, again centered in the United States.
It's a fast-growing US maker of spark plugs, windscreen wipers, and the other sorts of little pieces that go into cars. It's not a publicly listed company. In fact, its owner, a man called Patrick James, is so publicity shy, you'll struggle to even find a photo of him online. And First Brands has always stuck to the more private loan market to borrow money. But it's that debt that is now rattling some of the biggest names on Wall Street.
Now, they were being advertised by these big private lenders that you can loan this company $6 billion. They have a little bit of cash of $1 billion, so they're not going to go bankrupt. So investors just shoveled it down like a fat kid eating spaghetti. The daily active trading of First Brands debt was priced at above 100 cents on the dollar, leading all the way up to its bankruptcy. Investors were actively outbidding each other, clamoring for this debt asset. all the way up to the company's collapse. You can maybe make the case that a car parts company, we're not in recession, yeah, the risk shouldn't have been that high, so yeah, it's fair that investors pay up their money. However, the next example, which is Tricolor, a used car company specializing in subprime car loans, well shit, if that's not a walking red flag communist parade, I'm not really sure what is. However, the ratings company KBRA assigned a AAA rating to Tricolor in its June loan deal. But it's not fair just to blame the credit rating agency, the dude wearing a $2,000 suit, probably getting 150 grand a year. It's not just him, it's all of Wall Street. Everyone on average was pricing Tricolor's debt near to perfection just until a few days before they claimed bankruptcy. Obviously, the people that are investing directly in these products maybe know the risk that they're taking. They may have researched Tricolor as a business. However, once again, it's the financial industry and Wall Street cutting up and slicing and dicing these assets that's generating more of a systematic risk than just individual investors who maybe know what they're doing. For example, if we have a look at the number of companies here, it's pretty impressive that went into the business of slicing and dicing up First Brand's debt and likely selling it as these CLOs. It's quite extensive, maybe about 50 different names there. However, those private institutions, they maybe hold on to some of these CLOs themselves. They likely sell those CLOs onto big passive funds, such as ETF companies that need to manage tens of billions of dollars. They just almost buy blindly into all of these different CLOs of hundreds of different big businesses. So these two businesses that went into bankruptcy maybe affected millions of different investors, and I bet you not one investor looked into the risk of lending their money to First Brands or Tricolor. And we have not even talked about the biggest risk or the difference between the big banks and what happened in the GFC 2008 and what's happening today. Corporations have the ability to hide billions of dollars away from investors. This is called having off-balance sheet liabilities. Now, somehow this is technically not fraud, but if you're a company, you can just associate or sign that liability up to a separate entity, and therefore it doesn't need to be displayed on your balance sheet. Looking at First Brands again in their liquidation, they had $2.35 billion of so-called off-balance sheet liabilities, or about 1/3 of their total loans. If the average Joe did that with their car loans, or maybe with their tax liabilities paying taxes, then I'm sure average Joe would find himself in a prison cell. And to finish with one final little extra detail that makes all of this just more frustrating and kind of just embarrassing to regulators, is the big banks are still exposed to this risk. The First Brands collapse alone costed JP Morgan in the latest quarter $170 million. That tiny business costed the world's largest bank 1.2% of JP Morgan's quarterly profit, or about 5% of their quarterly loan loss provisions. That might not sound very impressive, but how many other large banks lost money because of First Brands, but also that let's say we're in a bit of a harsh recession, or many of these companies are collapsing all at once, how many names does it take to see JP Morgan lose all of their profit? And what is that going to do to the amount of loans that JP Morgan to make to other businesses or to everyday people trying to get a mortgage? And it's really at that point that everyday people are going to hear that there's some sort of financial crisis, but the unemployment rate's probably already gone to 6-7%, and your stock portfolio is already down 30-40%. Finishing off this summary of the private lending sphere, again, it's like 2008. We're playing with this Jenga tower. Every single business that goes bankrupt, we're taking out another piece, except in this case, it's almost like there's another player that's taking out pieces of the Jenga tower at random, unexpected moments. And therefore, I think this is the biggest risk currently to the economy and the stock market, but frustratingly, it's also one that is extremely hard to predict. And therefore, when I pose what sort of action I want to take to respond to this problem, I like to try and come up with a bit of positivity here. I still think the answer to this is just holding high quality companies and not buying into extremely diversified products that we don't really know what's happening with them. And subscribe to see in the long run if we do end up beating the S&P 500